Wall Street has fallen in love with the same 7 or 8 names, the same mega cap tech, the same chip stocks everyone already owns. And look, those companies are fine. But that is not what I want to talk about today. Because while everyone was crowding into the same trade, 5 companies quietly got hammered in the last few weeks. Not because they are broken, because they are risky and the market got scared. These 5 do not make apps. They do not make ads. They build the physical backbone of the future. Power, space, critical minerals, next-generation defense. Every one of them is led by the founder who still owns a huge chunk. Every one rides a government and reshoring an AI tailwind at the same time, and every single one just pulled back hard, which is exactly why they are interesting right now. I am going to walk you through all 5 biggest to smallest, and I am going to be brutally honest about the risk on each one, because some of these are the most volatile stocks on the entire market. And at the very end, I am going to rank all 5 by risk-adjusted upside, best to worst. The number 1 might annoy you because it is not the flashy one, it is the boring one that actually protects your downside. And number 5, the one everyone on the internet is screaming about, lands dead last. Stick around for that. Quick word before we go further. I am Sarah, and this channel exists to help you understand how money and markets actually work, not to tell you what to buy. This is education, not financial advice. And I mean it more than usual today because these are genuinely some of the most volatile names out there. They swing 20% in a day. Please do your own research and never risk money you cannot afford to lose. We put out videos like this daily, so if pulling apart real companies in plain English is your thing, you are in the right place. Now, before the names, let me give you the one idea that makes this whole video useful even if you never buy a single share. How do you tell a moonshot worth owning from a straight-up lottery ticket? 3 things. Number 1, a real funded catalyst with a date on it. A launch, a plant, a signed contract, not a someday dream, an actual event on a calendar. Number 2, a balance sheet that survives the wait. Cash in the bank, government backing, or real revenue coming in the door so the company does not run out of money before the good part arrives. And number 3, a massive market where being early actually pays you. Real catalyst, real runway, real market. Hold those 3 in your head as I go through each one, and you will start scoring them yourself. Let us start at the top. Rocket Lab, NASDAQ ticker RKLB. This is the big one of the group. Market cap around $48 billion, trading near $83 a share. It is run by Sir Peter Beck, the founder, who got knighted in 2024 and still owns about 10% of the company he built. Now, here is a man who could easily hype his own rocket, and instead listen to how he frames it. In a StockTwits interview this April, Beck said, and I quote, "The rocket always steals the show, but there is a bunch of stuff we are focused on that are really needle-moving for the company in the next 12 to 24 months. Translation, the flashy launch is the show, but the boring backlog is the business."
And space are the 2 big opportunities for humanity as we step forward.
I know.
And the business is real. First quarter of 2026, Rocket Lab did $200.3 million in revenue, up 63.5% from the year before. That is their first ever $200 million quarter. Backlog is up to $2.2 billion, more than double last year. They have flown over 50 Electron launches, which makes them the 3rd most active orbital launch company on planet Earth. They're still losing money on paper, a $45 million net loss, but that loss is shrinking. The catalyst everyone is waiting for is Neutron, their bigger medium-lift rocket, with a first test flight targeted for the 4th quarter of 2026. If that flies, it changes the whole story. Now the honest part. Neutron has already slipped from 2024 to 2025 to 2026, so nobody should assume that date is locked. The company is still unprofitable, the valuation is rich, and the reason the stock dropped about 10% on July 7th is that they announced an $8 billion acquisition of Iridium, and Beck himself filed to sell $465 million of his own shares. That is an overhang, and you should know about it. Analysts rate it a buy, with a 12-month range from around 60 on the low end to an average near 112 and a high of 150. Keep that founder honesty in mind, because the next CEO takes 0 salary and controls his company like a fortress. Number 2, AST Space Mobile, ticker ASTS. around $28 to $30 billion in market cap, trading near $74. This one is wild in the literal sense. They are building satellites that beam broadband straight to your ordinary cell phone. No special dish, no new handset, just your normal phone talking to space. It is run by founder Abel Avellan, who controls over 71% of the voting power and, get this, takes no cash salary at all. When they hit their big milestone this April, Avellan did not do humble. He said, achieving what many once considered impossible. We have reached the most significant milestone to date in our quest to deliver global cellular broadband from space. Bold. He is swinging for the fences, and he is telling you so.
Where you are, regardless of what phone you have in your hand, you will have broadband in your phone. You're making the phone a computer by basically connecting it to broadband.
The partners back him up. AT&T, Verizon, Google and Vodafone are all investors or partners, with more than 45 carrier deals reaching around 2.8 billion subscribers. They have about 10 Bluebird satellites in orbit now, and the next launch, Bluebirds 11, 12 and 13, is set for the first half of August 2026 on a SpaceX Falcon 9 out of Cape Canaveral. There is your dated catalyst. But here is the brutal truth. This is essentially a pre-revenue company. First quarter revenue was just $14.7 million against a net loss of $191 million. To deliver continuous coverage across the country, they need 45 to 60 satellites, and they have about 10. Continuous nationwide service is not targeted until the first half of 2027. They are burning enormous cash, capex guided at $575 to $650 million in a single quarter, which means dilution risk is very real and any launch delay hurts the whole thesis. That is why it crashed about 45% from its all-time high of $133 back in May. Analysts rate it to hold, low of 41, average around 85, high near 108. Huge dream, huge if. Quick pause. If you are getting value out of this honest breakdown, the pre-revenue warnings and all, do me a favor and subscribe. We do this every single day and it genuinely helps the channel. Okay, on to number 3, and this one actually makes money. Kratos Defense, ticker KTOS, market cap around $10 billion, trading near $50, and it dropped about 6% on July 7th. It is run by CEO Eric DeMarco, and DeMarco has the best line in this entire video. On his business, he said, "We have products now. It is not a PowerPoint of what is going to maybe be there 3 years from now." That is a shot at half the defense startups out there, and he is allowed to take it because Kratos does $1.7 billion in real revenue.
Programs like in the tactical drones, now we're going into production on the Valkyrie, for example, with the...
They build attritable drones, the cheap kind you can afford to lose, plus hypersonics and rockets. First quarter revenue was $371 million, up 22.6%, book-to-bill of 1.6, and they raised full-year guidance to $1.7 to $1.76 billion. Their Valkyrie jet drone, the XQ-58, got picked alongside Northrop for a Marine Corps program in January. Their hypersonics revenue is doubling to around $400 million this year. The whole thing rides the affordable mass idea, the Pentagon wanting lots of cheap drones instead of a few expensive ones. The risk here is different from the others. Kratos makes money, but it trades around 300 times trailing earnings. That is priced for perfection. Margins are thin, gross around 23%, defense contracts are lumpy and unpredictable. They will burn 85 to 100 million in cash this year, and they compete with heavyweights like Anduril and General Atomics. Analysts rate it a buy, low 75, average around 110, high 150. Real revenue, real tailwind, very rich price. Now, the next one is my personal favorite of the 5, and I will explain why at the end. Number 4, MP Materials, ticker MP, market cap around $10 billion, trading in the low 50s and down about 22% over the past 30 days. It is run by founder James Litinsky, who has led it since 2017. MP mines rare earths and makes magnets at Mountain Pass in California, and rare earths are the little metals inside basically every motor, missile and phone. Litinsky is not a hype man, he is a cautious operator, and on 60 Minutes this March, he laid out the whole reason this company matters. He said, "We need permission from the Chinese government to make things. That is not an acceptable condition." That is the entire national security thesis in one sentence.
Vertically integrated supply chain to truly solve the rare earth magnetics crisis.
Here is what makes MP different from everything else on this list, the de-risker. In July of last year, the United States Department of Defense invested about $400 million and became the company's largest shareholder at roughly 15%. And they set a price floor of $110 per kilogram on the key rare earth, which is about twice China's price. If the market price falls below that, the government pays the difference. That is genuine downside protection, which almost no speculative stock has. On top of that, there is a $500 million Apple partnership for recycled magnets, a General Motors offtake deal, and a defense-backed magnet plant. Business is growing too, record production up 63%, revenue up 49% to $90.6 million, and they even posted a small positive net income. The risks are still real. China can crash rare earth prices, and while the floor cushions MP, a crash signals a soft market. The magnet scale-up is unproven, the stock is priced for that build-out, and heads up, Litinsky himself sold over $70 million of stock between April and June. Analysts rate it a buy, average around 78, high up to 100 at Wedbush. Hold that government floor in your mind, because it is going to matter a lot when I rank these. Now for the wildest one of them all. Number 5, Oklo, ticker OKLO, market cap around $7 billion, trading near $48.70. It is run by co-founder and CEO Jacob DeWitt, who started it with his wife Caroline. And fun fact, Sam Altman used to be its chairman. Oklo is building advanced nuclear small modular reactors for the AI data center boom, because those data centers need firm, clean power around the clock. On CNBC this March, DeWitt gave the segment its headline with 4 words. He said, "We are in full build mode."
Oklo.
Yeah, it's a very exciting time for a couple of reasons. First of all, you have this confluence of growing energy demand driven by reindustrialization, electrification, AI, obviously, which gets all the headlines, combined with...
Here is the honest reality behind those 4 words. Oklo is pre-revenue. There is no reactor operating yet. Their Aurora powerhouse is a 50-megawatt design. They are sitting on about $2.5 billion in cash with basically no debt, and they lost $33 million last quarter. The deals sound enormous, a roughly 12-gigawatt agreement with Switch, a Meta deal whose first phase is as early as 2030, and a fuel letter of intent with Centrus for a big Ohio campus. But notice the dates. First Aurora power is targeted for around 2027 to 2028, and those giant deals only turn into real cash around 2029 and 2030. So the risk is simply this. Pre-revenue, no operating reactor, and the whole thing hinges on nuclear licensing and flawless execution years from now, with ongoing cash burn and dilution along the way. This is the most speculative name in the group, full stop. That said, analysts still rate it a buy, with an average target around 89 and a high of 140, though one outlier sits as low as 14. The stock is down about 75% from its high, which tells you exactly how violent this ride is. Okay, all 5 are on the table. Now let me rank them by risk-adjusted upside, best to worst, and this order is going to surprise some of you. Number 1, and my top pick on a risk-adjusted basis, is MP Materials. Not the biggest, not the loudest, but it is the only one with real and growing revenue, plus an actual government price floor underneath it, plus the United States government as its largest shareholder. Real downside protection is worth more than a bigger dream. Number 2 is Rocket Lab. Real revenue, a $2.2 billion backlog, and the neutron catalyst coming this year. It is unprofitable and richly valued, but the business underneath is genuinely humming. Number 3 is Kratos. $1.7 billion in real revenue and a screaming defense tailwind, held back only by that 300 times earnings price tag. You are paying up for quality. Number 4 is AST Space Mobile. A gorgeous moonshot with blue-chip partners, but pre-revenue, needing 45 to 60 satellites when it has 10, with heavy dilution ahead. The dream is real, the timeline is not close. And number 5, dead last, is Oklo. No reactor until around 2027 or 2028, and the huge deals do not convert to cash until roughly 2029 or 2030. The most speculative of the 5 by a mile. And here is the lesson tucked inside that ranking. Biggest is not the same as safest. The order by market cap and the order by risk are almost upside down. So what actually ties these 5 together? When you buy any of them, you are not really buying today's numbers. You are buying the promise of a catalyst. A rocket that flies. A satellite that connects a phone. A magnet plant that scales. A reactor that finally switches on. And the winners over the next few years will be the ones that turn that promise into a real dated result, on time. That is the whole game. That is what you are actually watching for. Use those 3 filters: real catalyst, real runway, real market. Watch the dates, respect the risk, and never bet the farm on a story. If this breakdown helped you think a little more clearly about the physical future the market keeps ignoring, subscribe and hang out with us. We do this every single day, and I would love to have you back. Take care of your money, and I will see you soon.